People far too often pay more taxes in retirement than they need to, or get surprised by the confusing rules in the tax code. One of the greatest factors in the taxes you pay over your lifetime has to do with the order of the account types from which you withdraw money. And in this video, I'll show you how much difference it can make so that you do it right and help your investments last longer. Welcome to another retirement tax planning video. I'm Dan Lohmar, CFP Professional with United Wealth Management, where we specialize in PRAP management and financial planning for pilots at United Airlines. And like many of you, my business partner, Alan Bewley, and I are both United pilots. Now, if you want to learn how to manage your taxes and grow your money so that you enjoy the retirement you deserve and help your PRAP last longer, then go ahead and subscribe to my channel on YouTube and hit the bell icon so that you get notified when new videos come out. When it comes to helping your investments last as long as they can in retirement, you must plan how and when you will use taxable, tax-deferred, and tax-free assets to manage your income and tax brackets efficiently. You cannot be haphazard about tapping your tax-deferred savings. Timing is everything, that is, as it relates to the stage of retirement you're in and which accounts you pull from and in what order. If you don't plan carefully through all stages of retirement, you may encounter unintended tax consequences. There are so many possibilities to strategize retirement income that it's impossible to say that one method works the best. The best thing you can do is compare your options as they relate to your situation and make an informed decision. For now, let me just show you a good example of how much difference the order of withdrawals can make, and we'll improve it a little bit with a Roth conversion.
So for tax-efficient withdrawals, what we're talking about here is comparing different withdrawal and tax strategies using the same spending plan that results in the least amount of lifetime taxes for the highest ending account balance. So when I underline the same spending plan, we're spending the exact same amount of money over our lifetime, but we're trying to do it in such a tax efficient way that we still end with a higher account balance compared to other options. So that's essentially what we're talking about. Conventional wisdom when it comes to tax efficiently spending money is that you spend down first taxable accounts, you deplete them completely, followed by tax-deferred accounts, deplete them completely, and then tax-free accounts. And that would be what you would end with, would be a combination of tax-deferred and tax-free accounts most likely. So the general idea of spending them down in that order, especially just taking advantage of tax-deferred or tax-free growth as long as possible. So the longer the money stays in tax-free accounts or tax-deferred growth, hey, the more opportunity it has to grow without paying taxes on it. So again, conventional wisdom, if you look at the types of accounts, so first you're going to spend down like cash and savings accounts, followed by brokerage accounts. And that makes sense because brokerage accounts, if you're, say you're doing some trading or actively managed mutual funds, those are taxed every year. So the sooner you get rid of paying taxes on those every year, the better off you're probably going to be. And then followed by like the 401k and the IRA or the PRAP, and then followed by Roth IRAs. And Roth 401ks are not bad, but I've got a line for those because they're just a little bit different of an animal. Yes, they're growth-free assets, and the money that stays in there grows tax-free. But the difference with a Roth 401k is it does have required minimum distributions, and so you don't really get to take advantage of the long-term tax-free growth of that money. So the workaround to that is to roll it into a Roth IRA. And then just remember, if you do that, there's a 5-year rule that applies to Roth IRAs. And I talked about in my last video on required minimum distributions, and I'll mention more about it in my next video on Roth conversion. So just keep in mind that that's there, but that's the workaround to it. And then once you roll them into a Roth IRA, then you do have lifetime tax-free growth without having to do required minimum distributions. So a question that comes up when it comes to the spending withdrawal is, where does the retirement health account fit into this? Because it is an entirely tax-free account that is used for qualified medical expenses after you leave United. Where does that fit in? Well, it's a use it or lose it account. So I think conventional wisdom amongst the pilot group, and I would agree with this, is spend it sooner rather than later because it does not add to your ending account balance. There's not really much of a cushion there because it doesn't go on to your family. And so I would say spend it down sooner rather than later. Asset location is another factor when it comes to tax efficiency. And so what that is placing investments and account types, taxable, tax-deferred, or tax-free, according to the growth and or income nature of the investment itself. So an example would be if you had a bond fund that kicked out a lot of interest and income, you would rather prefer that to be in a tax-deferred account so it's not taxed every time it kicks out income, rather than a taxable account. But there's some other considerations with that also. So in the big picture of asset location, you'd want to have your highest growth assets in your Roth accounts because that's what grows tax-free. So the bigger it gets, hey, the bigger amount of your net worth or your investment nest egg that is never going to be taxed. And then tax-deferred accounts would be more things that have more transactions, that kick out more dividends and income. And then taxable accounts would be low turnover things, passively managed type things. So in the individual stocks, if you have any individual stocks, low turnover funds like ETFs or index mutual funds, tax managed funds. So we use dimensional fund advisors, mutual funds. Their tax managed funds have very, very low turnover, and they tend to invest in companies that don't pay dividends. So they're very, very good at tax efficiency. And then municipal bonds are a good place for taxable accounts, depending on what your tax bracket is. And then also money markets, so more passively managed stuff in your taxable accounts. But just the idea of asset location can make a big difference in tax efficiency of withdrawals also. So I want to show you a hypothetical, and that's with Captain Joe again. And because I want to show you the difference it makes on the order of withdrawal. So that's what we're talking about and leading up to here. So he's starting with 2.4 million in his PRAP. He has Roth IRA for $100,000, cash for $200,000, which he built up his last working years. And IRA accounts for $210,000. His retirement health account, he has $100,000. And basically, as far as what he's spending, his given spending plan, he's going to spend year after year after year until the end of the plan, is roughly $140,000. So $7,200 a year, $130,000 a year in personal spending, plus $7,200 a year for United Retiree Medical. And then Medicare costs, the base cost of Medicare for him and his wife are $30,523. That's the base cost. We don't know where he's going to fall right now in relation to the IRMA Medicare threshold. So it could go higher than that if he goes above the modified adjusted gross income of $170 per year. But we'll take a look at that. That's part of the strategizing we look at. So what's the order of withdrawal going to be? The first thing Joe does is he strategizes Social Security and PBG first. That's the first thing he does because retirement tax planning is a longevity strategy. And Social Security and PBGC, when you're going to take those things, that's also a longevity strategy. So the first thing he does is he strategizes what's the best option for me to take PBGC and Social Security. And so what he decides, what's best for him and Jane, is to take it at age 70, and that's what they go with. So first thing Joe does after strategizing Social Security is, just as an example, and just show you the difference, is he does everything perfectly wrong, okay? So he takes Social Security early, and he just spends his accounts down in the exact opposite order of what he should. So in this case, he spends down tax-free first, followed by tax-deferred, and then taxable accounts after that. And as you can see here, I'm not going to say he's well-funded, but he is funded. So if you use average returns, he's funded his entire life at 127%. He has an ending account balance of roughly $1.5 million, but his account is depleting the entire time. If you do a Monte Carlo simulation on this, he's looking at about a 70% probability of success, which is not great. I would not take anything less than about 85% probability of success when I'm looking at spending and investment strategies. So is this doable? Yes. Is it probable? It could be stronger without a doubt. So this is a worst case scenario. He does everything backwards just so for comparison reasons. Now he turns things around. And the only difference in the strategy is the fact that he spent things down in the right order. So he spent things down in taxable accounts first, tax deferred, and then tax-free accounts. He spends the exact same amount of money over his lifetime. He takes Social Security at the same time early. I kept early Social Security in there just for comparison reasons. And as you can see, just based on the order of withdrawals, his ending account balance is almost twice of what the other one was. He's funded at 156%. So that alone makes a huge difference. If you did a Monte Carlo simulation on this probability of success would be north of 90%. So he's very well funded. So he asked himself, if this is the way I'm going to do it, how can I tweak this a little bit? Because I do have some RMDs that are above the Medicare threshold. So let's take a look at that strategy. And what he decides is that, yes, I can do some Roth conversions in my early years of retirement between 65 and 70. That helps lower my RMDs, and then also over my lifetime, it puts more money from tax-deferred accounts into tax-free accounts, so that gives them more opportunity to grow tax-free, and it does help him over the long run. It adds about $200,000 to his ending account balance. He's funded at about 160%. So as you can see here, when you do Roth conversions, there is an initial drawdown. It's a little bit steeper than what it was initially, but it takes a huge advantage of tax-free growth over your lifetime, and then over time, it makes up the difference there. So this is probably the best case scenario for him. So if you look at the worst case and the best case scenario, you can see there's a big difference in strategies. The only thing he did in the best case is he spent things down in the correct order, which is not rocket science. I mean, that's pretty simple concept right there. And he does some Roth conversions. So as you can see, there's a pretty big difference in what he does between worst case and best case scenarios. The last thing I'll say is, again, the objective of this is not to pay the lowest amount of taxes. It's to pay the least amount of taxes for the highest ending account balance. And so if you look here, if you look at a strategy where he does Roth conversions up to the 32% tax bracket, he does pay the lowest amount of taxes over here at $1.1 million over his lifetime, but his ending account balance is lower than it is on the best strategy, even though he pays a little bit more taxes with that. And again, it's paying the least amount of taxes for the highest ending balance. Our objective is not just to pay the least amount of taxes. So just wanted to point that out there for you. Okay, so questions always come up. This is a common question that comes up when you're talking about this, and that is, what if tax laws change? What if you start going down this path and then tax laws change? And it's a very good question. Well, life changes too, and we're going to have unexpected events in our lifetime that cause us to change course on what we're doing in many things. And so the best thing to do is go down a path based on what you know today, and then if tax laws change, you reevaluate based on the information you know at that time. So retirement tax planning and any kind of investment strategizing is not a one and done event. It's a year after year review. So every year you make the best decision you can with the information that you have on hand. What if all my investments are in tax-deferred accounts? And this is a very good question, because there's a lot of United pilots who will end up with the vast majority of their investable assets in the PRAP, and they won't have a whole lot in taxable or savings accounts and a whole lot in Roth accounts, just because the situation we've been in. But so this is a very good question. So the order of withdrawals doesn't really apply to this. But in my next video, on Roth conversions, I'm going to demonstrate how much difference Roth conversions can make on an individual who only has tax-deferred accounts. So yes, there are some Roth strategies that you can use if your only accounts are tax-deferred investments. And then another question is, it takes a while for these strategies to pay off. What if I don't live that long? And I love this question because what are you going to do? So let's just say you're convinced you're not going to live to 90, which is usually what our typical planning age is. Say you're convinced you're not going to live to 90 and you're only going to live to 80. Hey, yes, it changes things a little bit, but the thing is, the same concepts still apply. I don't think anybody, and I know we love to say that, hey, my last check I write to the underwriter or the funeral home is going to bounce. We want to run out of money as we die. Well, look, we never really know when that's going to happen. And so is it a great strategy? No. I think one of the worst financial situations you could be in your life would be having your money run out before you do. So I know we like to say that, but But it is a matter of longevity planning. We don't know when that date's going to come. But even if you were convinced that you're going to pass away at 80 and not 90, the strategies still apply, because you were still trying to maximize for a given spending plan. We're trying to maximize the account balance for the amount of taxes we're paying over a lifetime. So really the concept still applies. But yes, it does take time for some of these strategies to pay off. It's not an immediate payoff, and it does take time. There's no question about it. And you have to be comfortable with it. If you're not comfortable paying taxes up front for a strategy that may or may not pay off for you, then I totally get it, and that's a personal decision. There's no question about it. But the other thing to consider too is it's longevity planning. If you have family members, a surviving spouse, or a child with special needs or something like that, you're not the only one to consider. And even if you pass away early and your spouse survives you another 20 years, that's a huge consideration into the strategies that you're taking also. So I'll take any questions or comments. That's my email address, dan@unitedwealthmanagement.com, and also on YouTube, down in the show, in the video description, I've got a link, a contact me link. You can use that also. And I'd be glad to answer any questions you've got. I'll do my best to answer them to you directly or to address them in another video. And my next video is on Roth conversions. And so that you know when that video comes out, go ahead and subscribe and hit the bell icon so that you get notified.
You can see in the example that the order of withdrawals made a huge difference over Joe's lifetime. He then added in a sound Social Security strategy and some Roth conversions in lower tax years, and his outlook improved even more. As I said before, I will have a separate video just about Roth conversions and strategizing Social Security. Now, this is just one example of many possibilities. As a matter of fact, when we run our software, it actually kicks out 40 different strategies, and the strategy you choose should be based on your specific situation, and it's likely going to be much different than everyone else's. There are strategies that are very aggressive at reducing RMDs and lifetime taxes, and those usually require paying more taxes up front, and you have to be comfortable with that. Whatever strategy you choose should be evaluated each and every year. Tax rates change, spending changes, and unforeseen life events happen. This is not a one-and-done approach. Revisit your strategy each and every year. The main point here is to show you that withdrawal order can make a big difference. I also mentioned Roth conversions, and that's what my next video is about. So that you know when that video comes out, go ahead and subscribe and hit the bell icon so that you get notified. I'm Dan Lohmar, CFP Professional and Registered Life Planner with United Wealth Management, where we specialize in PRAP Management and financial planning for pilots at United Airlines. And like many of you, my business partner, Alan Bewley, and I are both United pilots. Contact me at dan@unitedwealthmanagement.com if you'd like to explore what we can do for you, or use the contact link in the show notes on YouTube. Also, come over and visit our website, unitedwealthmanagement.com. Until next time, fly safe and invest with a plan based on science and evidence. Everything else is just guessing.